globally, not just in China. The three largest components of tires are natural rubber, synthetic rubber, and carbon black. And since the summer of 2010, natural rubber has gone from $1,300 a ton to over $3,900 a ton, 300% price increase. Synthetic rubber has doubled, carbon black has doubled. Now the impact in China is much greater to the final cost of the product with raw material increases than it is from our domestic supplier, Cooper. The reason for that is in China, 85% of the cost of the product is raw material, 15% of the cost of the product is labor and processing. In the U.S., it's about 50-50, 50% raw material, 50% labor and processing. So a 20% increase in raw materials in China reflects about a 17% increase in cost of product. In the U.S., that same 20% cost increase in raw material only reflects a 10% impact on the cost of the product. So through this year-and-a-half process of very substantial raw material price increases, our cost in China has been impacted more severely than our costs from our domestic supplier. Another factor that we're facing is the escalation in wages in the Chinese manufacturing facilities. In 2009, the average tire worker was making about 1,250 RMB a month. As of this past summer, it was up to over 2,500 RMB a month. Now, it's still relatively small compared to a US worker, but for the Chinese factories, it's a big impact as they're having to deal with this inflationary process with the wages that they're paying, and it's going to continue on. You know, one of the great things about the Chinese economy is there are more consumers emerging every day in China. Well, as consumers, they want to take advantage of the products and services that are available, and it takes more money to be able to do that. So those are things that we believe we're going to continue to see. So just to close for this opening portion for my company, we're going to see continuing pressure on salaries. The global supply of natural rubber and oil is going to continue to be stretched. We'll see continuing pressures on the cost associated with those raw materials, which have direct impact on the cost of product. And then we're going to continue to see our administration in Washington looking for ways to satisfy organized labor by imposing tariffs and duties. There are rumors right now of another effort underway for the tire industry to impose additional tariffs. So I thank you for letting me participate this morning and look forward to learning about the other companies involved. Thank you.
Thank you. Good morning. My name's Tom Koltun. I'm the president of Kolcraft. Kolcraft's a company that makes juvenile products such as baby walkers, bassinets. We're also a licensee of Jeeps. We make strollers under the Jeep name, potties and walkers and other products under the Sesame Street name, and crib mattresses under the Sealy name. We started in 1946. This year we celebrate our 65th anniversary. We started doing business in China in 1985. Well, actually, we started in Taiwan and then eventually went to China with our suppliers in the late 80s, early 90s. We went to China because of lower costs. Obviously, it's a lot less expensive to make products in China. Also, the barriers to entry were lower. We had a small R&D department, and we were able to get in categories that we currently weren't manufacturing in, such as baby strollers. For us to make the capital investment in the injection molding equipment and the tomb bending equipment would have been very substantial. So by going to China, we were able to get in the category very easily. We searched for manufacturers when we first went over. got some names from people. We focused on the opening to mid-price points because some of these manufacturers were already making those kind of products. We picked a manufacturer based on the products that they made. It was simple as going into a showroom, seeing products on the wall, picking a frame, changing the colors, changing the wheels, and we were in business. We then narrowed the supplier base down to a few so we could work closely with them. We eventually started developing products with them, so much to the point we started sharing tooling costs with them. So for a small company like ours, it was a great way to get into the business. The only downside was years later when we wanted to move a product, they kind of had their hooks into us. But it was still a good way for us to start out. Now we're developing most of our products on our own, but we still do some joint development with them. By developing products on our own, it allows us to get some quote packages together and go to multiple sources. This gives us a very competitive price that we feel that we're not leaving anything on the table. But price isn't the only factor. Quality is very important. You can get a great price, but if you're getting returns from your customers, then you've kind of shot yourself in the foot. The reputation of the manufacturer is important to us. Our industry is very small. We know who all the players are, and if one of our competitors is having a problem with a factory, then we try and stay away from that. What is the infrastructure? What kind of processes do they have? Do they have QA, QC, incoming inspections? On-time shipping. We sell mainly to Walmart, Target, Babies R Us. They expect the product to be delivered on time, so we have to make sure the factory can get the product out on time. And also, when they give us a quote, do they stand behind the quote? Many times, we get a quote from a factory, and as we're going through the process developing the product, they realize they forgot a part, they forgot a wheel, they forgot this, and we've had many issues where we've had to then go back and force them to stay behind their product or all of a sudden take out cost. Price increases. Jim spoke about price increases. We've felt price increases. Up until about 2005, a price seemed to last forever. Starting in 2005, we got our first taste of price increases, and we thought, okay, this might be a one-time event. Then it happened in 06, 07, and then in 08, it just went off the charts. The price increases come from raw materials. We deal a lot with steel, plastic resin, and then this last year, when cotton increased, it affected us also. The renminbi appreciating has also been a big factor. So much so, it's almost a bigger factor than the raw materials because it affects the whole product itself, not just one component of the product. And labor is also going up. In this past couple of years, we've felt the effect of that, but also labor is a smaller percent, and the labor rates are so low there, it wasn't as significant, but labor keeps going up. Now we require a detailed price breakdown from our suppliers. Before we got one price for the whole product. We didn't really have detailed bills of material because prices lasted forever. It really didn't matter. Now that we're getting all these price increases, we need to know where the bulk of the prices are so we can try and take prices out to try and offset some of these price increases. It's funny that our oldest suppliers actually are having the most difficult time with this. They really don't like sharing their bills of material. They feel that we may go to a competitor to get a better price, but you can reverse engineer a product, and so that's really not a factor, but finally they've agreed to give us this information. Just a quick background on Kolcraft Far East. When we first started out in China, we used an agent model. We paid a percent of the order as a commission. The agent helped us with the shipping documents, with getting the order placed with the factory. In 2006, we changed and opened up our own office in Zhongshan, China. We also then opened up a small office in Hong Kong where we have project engineers. We'll spend one day in Hong Kong, and then the rest of the week they'll go into China. In January of 2012, in about 6-8 weeks, we're going to open up a WOFE, or a wholly owned foreign entity. This will allow us to sell in China. It also allows us to pay our employees directly. Right now we're going through the FESCO, and we can take those costs out of the system. Future. For us, for our industry, retailers are now going directly to our suppliers to try and bypass us, cut us out, which really were the middleman. They want to get better pricing, they want better margins, and so they are trying to develop some of their own products. They even have they've hired people to do their own sourcing. Right now they focused on opening price points like we did because some of these manufacturers have their own models, but they are working on more expensive models. So obviously we're very concerned, but since our industry is regulated heavily by the government, they will have to deal with safety issues on their own. Right now we're kind of the middleman, the buffer. If there's a recall, there's an issue, it kind of falls on our shoulders. So to protect ourselves, to continue to stay in business, we need to work on more innovative products that we can patent and protect ourselves. But costs are still increasing. As we develop new products now, we add buffers. A lot of our products can take 1.5 years, 2 years to develop, so we will add what we try to anticipate are the renminbi still appreciating, raw materials still going up, and labor still increasing. Thank you.
Okay, good morning. I want to introduce the subject here by just in my remarks, just describe how Navistar, as a primarily North American truck and engine manufacturer, has now adopted a strategy to build and sell products in China. At a glance, I think many of you know Navistar, but the company really was formed back in 1831 by Cyrus McCormick. The company was incorporated as International Harvester in 1902 and restructured into Navistar in the mid 1980s. We're about in 2010 we had about 12 billion in revenue. That'll probably look more like 15 billion in 2011. Roughly 80% is our truck business, and 20% or so is our engine business. We've got about 18,000 people worldwide. We're based near Chicago. We have well over 1,000 dealer locations in North America, and we have a growing worldwide presence in both our truck and engine business. We manufacture in the United States, in Brazil, China coming on stream in 2013, India started manufacturing in 2009, and also Mexico and Argentina. We have a portfolio of brands, but all in the same industry. Commercial vehicles, trucks, derivative military business, school buses, and diesel engines to power that equipment. We have a very strong base in our core market in North America. You can see in this chart that we're either number 1 or number 2 in market share position in our truck business. And from a growth perspective, you know, we're looking for ways where we can take the kind of the technical strength and the market strength that we've developed in our core territory and somehow apply that as we enter new markets. Within our engine group, which I represent, we have a new brand called MaxForce, which we're using worldwide to represent our engine business sales outside of our core truck business. We're forming and have formed a components group which is aimed to develop and acquire key technical components of our engines. That's the fuel systems and turbocharging and the like that are quite complicated and now represent well over half the value of the engine. And finally, we have a metal castings business, which someone commented earlier has made a remarkable recovery in the U.S. A few years ago, almost everybody with a metal casting foundry was looking for ways to get out of the metal foundry business. Today we studied the situation, and we put a large investment back into that business in Indianapolis and Waukesha, Wisconsin, and we're finding we're insourcing a product in that particular industry that we used to buy from Brazil, Mexico, or even China. Success story for American industry in that respect. This is the main point of my remarks, though. We realized as a company 10 or 12 years ago that it was really necessary for us to diversify and grow outside of our core territory. If you took a picture of Navistar 10 or 12 years ago in 2000, we as an engine group, we had essentially 2 customers, and from a total company point of view, well over 95% of our revenue was based in North America. You can see on the chart here that we have a vision to grow from maybe 400,000 unit sales in our engine business to well over 600,000, and diversify from a North American base to a much more balanced worldwide base. And we're doing that in a couple of ways. You can see in the U.S. part of the map that remains our core business. But 10 years ago, we acquired 2 manufacturing firms in Brazil, and we began manufacturing engines in Brazil at that time. And this year, 2011, we're launching our truck business in Brazil. We occupy the #1 market position in engines in Brazil, and we want to build on that strength as we improve our truck business as well in that territory. 5 years ago, in 2005, 6 years ago, we entered a joint venture in India with a leading Indian manufacturer, Mahindra and Mahindra, and we formed a truck and engine joint venture which came on stream in late 2009. And as with the Brazil acquisition, Brazil was an acquisition, India is a joint venture, but followed the same playbook where we have our North American core technology. We apply it locally with a local partner who understands the market and the customers locally, and we manufacture in India primarily for the Indian market. And that takes us to China, where over the past 2 or 3 years, we had deep discussions with a leading Chinese automotive manufacturer, JAC, based in Hefei, the capital city of Anhui province. We secured our respective board approvals in 2010, and we're in process of forming the joint venture pending government approvals. The playbook is similar to what I described for Brazil and India. We're taking core elements of our North American technology. We're taking our expertise in manufacturing and quality systems, and we're going to be manufacturing in China primarily for the Chinese market. And our business there is basically the same as it is in North America, which is commercial vehicles and diesel engine manufacturing, but obviously adapted for the China market. As part of this, of our business in China, we're very anxious to set up a supply base. And again, it's a supply base to supply our business in China. And if we can also find suppliers to supply our U.S. or Brazil operations, that's great. But we're basically in business in China to do business in China. Where do we see things going? Well, okay, we're well on the way to getting all this set up in China. Unlike we're setting up manufacturing, distribution, service points. Our investment is in, as I said, heavy-duty trucks and high-technology diesel engines. Where are we going? Well, the heavy truck business is a lot different from the automotive business. I'm sure that almost everybody here knows that General Motors has had a terrific success in China in its passenger car business. So has Volkswagen, So have BMW, Mercedes, and others. Track record in purely commercial vehicles is a lot more mixed. In fact, it's hard for me to think of a highly successful commercial truck venture in China, and we're working very hard to be that success story. I'll take some questions later on industry trends that may be of interest to the group here, but we do have a business model that we think will lead us to success. Now, what's going on with the I'll just call it the commercial vehicle portion of Chinese industry. I'll say that environmental rules and safety regulations and the like that are so much a part of our North American automotive experience, believe me, they're there on paper, but they're not there in practice. As an example, China in 2010 was supposed to have adopted Euro 4 emissions regulations, which is pretty much similar to our level of emissions regulations in the mid 2000s. It looks like that will happen on a very inconsistent basis, and that affects technology suppliers such as Navistar and our suppliers such as Bosch, who supply the higher technology components for these systems. On a positive side, much more positive side, anyone who's been to China knows that the road network and the transportation network is improving at a tremendous rate. In fact, a common observation is that the highways between Beijing and Shanghai are much better quality than the highways between Chicago and New York. And part of that tremendous investment that China has made, we think is going to end up in tremendous improvements in logistics systems, and that in turn will drive demand for higher quality and more productive heavy-duty trucks. Also, if you've seen the China system, you can't help but notice that there's a tremendous amount of working capital tied up in rail cars, on the side of the road, in warehouses and the like. And as people figure out how to apply North American just-in-time type systems, we think that's also going to drive a demand for improved transportation systems. Last comment, caution, this is a long-term perspective, and we don't expect this to be a 1 or 2 year process. And the last chart I'll show here is really a description of how we see the China market evolving. And this is just it's just a marketing perspective. But if you look at the bottom part of the chart, you'll see a big box that says price buyer. And for commercial vehicles, that pretty much characterizes the state of the business now. Price is more important than dependability. Price is more important than not breaking down. Price is important. There's emerging a value type buyer who's willing to pay a little bit more for more reliability. And we see a smaller sector in what we call productivity buyers. Those are customers for commercial vehicles in this case who pay attention to lifetime cost of ownership, fuel economy, driver retention, all the things that kind of characterize the North American market. That's maybe 5% of the market today. As the improvements I mentioned in the prior slide materialize, we think that'll grow to 20, 30, 40% of the market, and that's basically where Navistar is set to play. And you can see that on this final chart here. Today, your productivity sector on the little bar is a little tiny piece at the top, and that might be, as I said, 40, 50% down the road. And we're positioned, Navistar, with our partner JAC, to take advantage of that market trend. I'll close my remarks with that and turn it back to Andy.
Thanks, Steve. Before I forget, I would just like to thank SEVA and Mai for putting together another great event. And also, over the last 10, 15 years, you have created a wonderful community of business and government leaders that are all focused on trade and investment in China, and we all benefit from your leadership, SEVA. Thank you very much. Let's give them a hand. I'd also like to thank Sal and Lou for your leadership in helping organize the event. This is a great program, and we all appreciate the work you've done helping SEVA put this together. So again, thank you. Before we move into the Q&A, I just wanted to make a couple of comments. When Stephen talked about the infrastructure development, you all read a lot comparing China today to the U.S. at some point. And at my company, we've done a lot of our own research in this area, and we feel that regarding infrastructure and transportation, China today is like the U.S. in the 1960s. If you may recall, the Eisenhower plan to develop our interstate highway system was started in the early 1950s, and it happened over a 20-year period. It's still going on today. But if you think about the U.S., you know, we did a study comparing Denver to Chicago. It used to be, it's 1,100, 1,200 miles away. It used to take a truck 2 or 3 days to get from Denver to Chicago. Once the highway was built, it's like a 16-hour drive, which meant a factory in Denver can get an order today at 2 in the afternoon, and they can have it delivered to their customer in Chicago the following morning. Well, all of a sudden, the trucking industry developed, the freeways, individuals started buying cars because they could more easily travel, and then all of a sudden McDonald's was built, Holiday Inns were developed, all of the related travel and service industries, gas stations started to develop, and we're seeing all of those industries in China start to develop just like they did in the U.S. in the 1950s and 60s. So it's all based on you get the infrastructure and then all of the related industries. And I feel that as the Chinese middle market continues to expand, individuals are going to have more money to buy things and travel, etc. So it starts with basic infrastructure and goes from there. The other big thing for all of you, many of you who've not done much yet in China, I think that there's a very well-developed network of advisors and consultants to help you all look at doing business and investing in China. Companies like Cat & Muchin and Plante Moran for legal and accounting and consulting advice. There are many market research firms. There's companies that help find partners, executive search firms, etc. My company, we use